Hi, today from Palermo, Italy. Today we will talk about one of the three investment fallacies about prolonging the curve. See you in the next part. I will give you today three examples for the fallacy in investments called prolonging the curve. Let's start with the first example, gold. There is a rule in investments that in the long term, gold is keeping its value. 2000 years ago in ancient Rome, for 1 ounce of gold, you could dress yourself completely as a man. And today for 1 ounce of gold, meaning more or less $1,200, you can dress yourselves completely as a man, as a gentleman. And maybe you will even afford a watch on top of that. So on the long term, gold keeps the value. One rule of thumb in investments and the other rule of thumb in investments in crisis, people flee into gold. This is a rule of thumb and it's a curve, meaning on the long term, the value of gold is constant. So if you want to preserve your money, if you want to preserve your capital, you should keep your capital in gold, because if crisis comes, your capital will be safe if it is stored in gold, right? And you never know what's gonna happen if it's stored in some other assets that are maybe not as stable as gold. But this is just a rule. And what I'm telling you today, this may be really expensive lessons for a lot of investors nowadays in today's situation. Why? Because of two reasons. First of the reasons is up until today, up until several years ago, there was no alternative to gold in crisis, when it is about stable assets, about non-inflatable assets. So the capital in crisis could flee only into gold, maybe also in real estate, but real estate, it's not inflatable, but it can create bubbles, and it does create bubbles. So it's not the best store of value, and it's not crisis proof. So conservative capital was fleeing into gold in crisis up until several years ago. But today we have alternatives, and the alternatives are cryptocurrencies. Maybe not all of them, but some cryptocurrencies have all of the qualities of gold and are not inflatable. So there is an alternative to gold that can capture a lot of capital in a crisis. So if you count on this rule, on this curve of gold price stability, gold value stability, you may be extremely disappointed in the next crisis. Because it may happen, I don't say it will happen, and it is not financial advice. I'm not giving you financial advice here, I'm telling you just my opinion. I'm not your financial advisor, but in the next crisis, a lot of that capital may flee into cryptocurrencies and not into gold. And that means that if we come into hyperinflation, gold may actually lose its value and not keep the value as it was in the crisis before, in the earlier crisis. This is one of the reasons. And the second of the reason is very simple. People assume gold is uninflatable, meaning you can't inflate gold by more than 2 and 2.5%. This is due to large amounts of gold stored in the world, and the impossibility of produce large amounts of gold that will inflate it in considerable, palpable amounts. Check out my earlier video here. I will provide a link in the comment, and I will try to connect it here also. I was talking there about the production elasticity. And this is an assumption that may turn out to be wrong. It was a true assumption for thousands of years, when the only method to actually produce gold was to dig it from the resources we have available on Earth. And gold is pretty scarce mineral when we are talking about Earth, but it's not scarce at all in the universe. And I personally have friends who scan the asteroids for precious metals. And for example, there is one asteroid. It is, I guess, 5 kilometers long and 3 kilometers broad. And this asteroid consists of 60% of gold. And then there is a platinum and other minerals, other precious metals. And its value is roughly $5.4 trillion. Trillion dollars, meaning 5.4 thousand billion dollars. An enormous amount of gold. Another friend of mine wants to actually build a spaceship to mine the moon, and also will be able to mine asteroids. The first spaceships were landing on asteroids already, so it's just a question of time. In my opinion, it's maybe 5 years, maybe it's 10 years, maybe it's less, maybe it's more. But it's a question of time when a piece of news will appear saying, we are on a mission to go to this asteroid and mine it and bring back like thousands of tons of gold. What would happen to the price of gold in that scenario? Gold could be inflated by several 100% in just several years. And alone the rumor of this happening would bring the price of gold down to almost zero, or maybe not to zero, but by several orders of magnitude. From $1,200 today, it could go down to maybe $100, even less. And it will never come up again, because there will be technology available to cheaply produce gold, to cheaply manufacture or to cheaply make huge amounts of gold available in the universe. So don't prolong this curve, don't follow this rule and assume this rule will be valid forever, that gold keeps value in the long term, and that gold is a safe haven when it is about financial crisis. This may not happen in the next crisis, and actually it may never happen again. This was the first curve that I encourage you not to prolong. The next curve that I want to tell you about is the Moore's Law. You have certainly heard about Moore's Law. It defines the development of computer industry in the world. It says that roughly every 18 months, the computing power that you can buy for $1 doubles. And this means the growth of computing power is exponential. The computing power that you can buy for $1 doubles every 18 months. And this is why such things like virtual reality, artificial intelligence, and so on became possible. That's why things like video streaming or even YouTube that you are watching now became possible. Although in the 90s it was unimaginable that we would have such processing power. And also the computing power of your mobile phone is bigger than the computing power of supercomputers like 20, 30 years ago that costed millions of dollars or hundreds of millions of dollars, and now you can get it for several $100s and have it in your pocket, this computing power. But what I am telling you is that this is exponential curve. And every exponential curve at some point breaks. Every exponential growth breaks at some point. And we don't know how far away we are from this break. So if you set up your investment strategy with this in mind, that the computing power will double every 18 months, that you will be able to buy a computer with the same computing power in a year for half a price, or in 18 months for half a price, or let's say in 3 years for 1/4 of the price. And this is how you compute your business model, or you invest in this or that company with this assumption that it will be possible, so their cost will reduce by that factor. Then you may experience a severe disappointment, because despite the fact that this curve was true for the last 50 years, despite this fact, this is an exponential curve, and exponential curves never continue endlessly. At some point, they will have to break, because that's the nature of the world. None of the exponential growth can be sustained endlessly into the infinity. So at some point we'll experience a break of that, and you don't know if you are 1 year, 2 years, or maybe 5 years away from that. And if your investment strategy or your business strategy is based on these assumptions, you may be really wrong, and some people may lose a lot of money with that, and some other people may earn a lot of money, because they will look for the early signs of this curve breaking. And I would encourage you to assume this curve will break at some point. We don't know how far away we are from that, and maybe you can provide in comments the possible signs that we may look out for in order to spot as early as possible when this curve is about to break, and then we can act accordingly, because you could then short the stocks of these companies that are, so to say, dependable on this exponential growth, or you may employ this knowledge in some other area.
Another fallacy is the belief in the stable inflation curve of the dollar or of any other fiat currency. You know that central banks want to have inflation on the currencies. Let's say the Federal Reserve wants to have a stable inflation of between 2 and 3% on dollar, and prints money and controls the interest rates in order to control that inflation, or in order to keep that inflation in place. So most investors take it as a rule that there will be inflation between 2 and 3% on dollar, meaning that the purchasing power goes down asymptotically of the dollar, and it also means that the assets gain in value, like the stock market and the other assets gain in value, or real estate, alone by the virtue or by the value of inflation, and with that speed, right? So yearly at least 2 to 3% are added to the value of the assets. But in a bear market, it is safe to get out of the assets in fiat currency, in dollars or in other currencies for a short time, or even for a year or 2 years. It's just a risk of losing 2 to 3%, while the stock market may lose at that time maybe 20, maybe 30%. So it is better to hold your money in that asset. So this is the rule of thumb, or the curve that was valid for the last 20 or 30 years already, and people assume it will continue like that. that the Fed or other central banks will always keep the inflation in check, and the inflation will be 2 to 3%. But this is a big fallacy, because the quantitative easing and other measures of central banks mean that they print a lot of money. The amount of money in the world tripled in the last 10 years. But for sure, the productivity and the amount of wealth in the world didn't triple, didn't even double in the last 10 years. What does it mean? It means that the real inflation speeds up, and if the speed of printing money by central banks and also by the Fed continues like this, like it is today, we will come into hyperinflation. And keep in mind, every fiat money ended up with hyperinflation. I was born in a country where since the Second World War the money has been exchanged 3 times, and every time, like every 20-30 years, the money lost 99.99% of its value. And it is not a third world country, it is a European country. And even in Germany, in a highly developed country, we had a hyperinflation not even 100 years ago. So almost every country now, or actually every country in the world that uses fiat money was affected by hyperinflation already. Some countries have been affected by it several or multiple times. We have hyperinflation in Venezuela right now, and in some other countries, but it is a realistic scenario even for a dollar to be affected by hyperinflation and by any other fiat currency, because the policies of the central banks lead into that. And to believe that the central bank will be able to always keep the inflation in check is just naive. So I wouldn't bet on that in the next financial crisis. If you sell your assets and keep the money in fiat currency, for example in dollar, that this is a wise strategy, because it may come to hyperinflation and your fiat money, the cash that you are holding, will lose most of its value immediately or in very short period of time. And the thing is, there are right now the alternatives like cryptocurrencies, and when people start fleeing into these alternatives that are not inflatable, then this inflation may get out of control. And when the inflation goes up to 20 to 30% a year and more, people will lose faith in that currency when they start to see the difference in purchasing power of the money. When they go to the shop in a month and realize, you know, the price has got up and stuff like that, then they will lose their faith into the currency, and that's where the hyperinflation starts, because then they will try to get rid of the currency as fast as possible, and that's how hyperinflations always start. So this is another fallacy. Don't continue this curve, that this inflation curve, that the money loses only 2 to 3% of its value every year. Now it can lose 30%, and even it can lose almost 100% of its value in a year. Go to Venezuela and you will realize it is possible, and it will happen in every fiat currency. The question is when.
Why am I telling you all of this from Palermo? I'm telling you all of this from here, from Palermo, Sicily, because Palermo is just a perfect example why prolonging the curve doesn't work. Why? Because Palermo had so many abrupt changes of direction in its history, it's just unbelievable. I will read to you the different rulers that Palermo had in its 2,500 years of history. It was founded by Phoenicians, then it was ruled by the Greeks, the ancient Greeks, then by the Romans, then the Vandals fall in and captured Palermo and were ruling here in Palermo. Then the Ostrogoths, then the Byzantines came, then the Arabs were ruling here. They had the mosques here, they were the rulers here. Then the Normans, the long dynasty of the Normans, then the German Staufer, then the French were ruling here, then the Spanish, then the French again, then Habsburg dynasty, the Austrians, so to say, and then finally the Italians. And of course it was ruled by mafia for a long time. And in between it was even under short English protectorate. So you see how many changes in history, abrupt changes in direction Palermo had to endure. And that's why prolonging the curve doesn't work. If you believe the next several years will be like the last several years, it is a fallacy. It's extremely dangerous, especially in investing. You will fall flat on your face if you design your investment strategy along these rules, along prolonging the curve. And here behind me you see the Cathedral of Palermo. And this cathedral was built as a Byzantine Christian church, Byzantine Christian cathedral. Then it was used as a mosque by the Arabs when the Arabs were the rulers here in Palermo. And finally it was again used as a cathedral, of course reconstructed, changed and extended by the Normans. So again by Christians, to a Christian, to a Catholic cathedral here in Palermo. So you see how the history changes, and modern investing changes even quicker. I invite you to leave a comment, give me some other examples where these curves may break, how we can look out for the first signs of these curves breaking down. Maybe you have some other examples where these curves may work or may not work anymore already. Share this video with your loved ones, with your friends. One day they will thank you for that. I talk here a lot about investment strategies, about cryptocurrencies. I talk here a lot how the best entrepreneurs in our world think and act, how the self-made billionaires in our times think and act. So if you liked this video, you will certainly like my other videos. I invite you to watch them. That's it for today from Palermo, Sicily. I wish you a fantastic day. Let's do something extraordinary today.